And get some perspective going with Rajesh Kothari, Managing Director of AlfAccurate Advisors. Rajesh, before we start talking India and what you've been doing in this correction, actually, just your thoughts. I mean, from an Indian investor standpoint, I'm sure you're very carefully observing what's happening in China. And the thing is that even Indian investors, whether it's retail investors or HNIs, suddenly everybody wants a piece of the action. And I have heard a lot of retail saying, okay, which China funds are open? Should we start putting in the money? But your thoughts on whether this poses a new challenge for our market recovery?
Hi, Shruti. I think sometimes access to information becomes your enemy, So narratives plays the role. And from last 4 years, we have seen that. And I think the only lesson to be learned, at least by the retail investors, more importantly, because generally they fall into this trap, is not to believe in narratives and look at the actuals, the fundamentals, the ground reality, and do what you understand the most. Because if you start doing the things which you don't understand, exactly 1 year back, everybody was talking about India and nobody wanted to talk about China. And exactly 12 months after that, China has outperformed India by 40%. And now everybody wants to talk about China. Same thing is for gold. 36 months back, 24 months back, 12 months back, nobody said invest in gold. And today when I meet some large family offices or even HNIs, they say, Rajesh, should we consider now gold? Gold has already done the best of it, So I think sometimes you need to a little bit sit back, relax, think twice, don't get into the euphoric trade, either side of it. Just analyze two simple things between greed and fear. Where are we? Be it asset class, be it stock, be it equity market, be it India, whatever you are doing in terms of investment. On that greed and fear pendulum, where are we? And it's always better to be a little bit greedy when others are fearful and be a little bit fearful when others are greedy. If you follow this simple common sense of human behavior, at least you will not lose money. I don't know how much you can make more, but at least you will not lose money.
Okay, so don't go into fashionable investing, much like fashion trends, right? We chase whether it's a boot cut that's in or a straight cut that's in. Last year it was India, right now it's China. But Rajesh, you're saying that don't go with what's fashionable, go with what's right. So speaking of that, now let's come to the correction here. First question, I mean, in the middle of the week, we were getting a little hopeful and it seemed like the market is bottoming out. At least the process of bottom formation is on. What do you think? Is the worst of the pain for mid-caps over?
Well, I think from the three different parameters, the trinity of the three things. The first is look at macro. The macro side, the inflation is cooling down, which is good. The interest rate, RBI has done the first rate cut after a very long time. That is good. The banking liquidity is improving. That is good. So first, the macro side is coming to your favor. Now let's look at the micro side. On the micro side, the third quarter corporate India growth, if you look at BSE 500, it has been around 10%, which is not bad. In second quarter, it was just 5%. First quarter was also very low single digit. From low single digit, we are now at least 10%, which is good news. And because of the union budget, 1 lakh crore gift, probably this will now improve. And maybe from September quarter onwards, I mean 2Q FY26, you will see good double-digit earnings growth, maybe 12%, 14%, 15%. So that is basically the micro. So macro is turning in your favor. The micro has already started turning in your favor. And the third part, very important part, is the valuation. Because that's where the margin of safety comes into play. So today, if you look at the Nifty, we are below 10 years average price to earning multiple. Very simple valuation metrics I'm using. Where are we on 10 years average PE? Of course, in last 10 years, ROE has improved, the corporate balance sheet has improved, the digitalization has improved, India rank in terms of GDP has improved, and many more things happened in last 10 years. So I'm not entering into debate, should we trade it structurally better PE compared to what it used to be? But even if you assume that 10 years PE remain as it is, today we are trading below 10 years PE. And it means it's a good time to invest in. Now, does it mean that market will not go down tomorrow by another 3, 4, 5%? Who knows? It can go. But when you have a 3, 4, 5 years investment horizon, I think that if you invest today, at least from the multi-cap perspective, chances that you will make good double-digit returns with a 3+ year time horizon is in your favor. Coming to mid and small cap, yes, there was a valuation froth, but unfortunately, we should stop using this terminology mid and small cap. Because in India, out of 5,000 listed companies, only 100 are called large cap as per regulatory definition. It means only 2% of India is large cap. But reality is somewhere else. Because India's largest fastener company, or India's largest mall, which is listed, or India's largest bearing company, or India's largest luggage company, or India's largest plywood company, they all are largest, but they go into mid and small cap because they are not top 100 by market cap. So I think we should stop using these generic terms whether mid cap looks good or mid cap looks bad. I don't think so. I think the top 500, 600 companies, which are listed part of it, I'm talking about, which makes 100 crores plus reported net profit after tax, that's the universe where one should invest starting now. There might be another 5-10% decline, which is possible. I'm talking from 100 to 500 company, 100 to 600 company, but the good pain is already there. We are seeing many stocks are down 20, 30, 40%. We are seeing the correction in valuation, but the earnings growth is now going to improve. Of course, one needs to be selective, and that's the universe we would like to play within. Moment you go out of 800th company, from 800 to 5,000 company, that's where there is a lot of growth. And that's basically what I would say micro cap rather than using the word small cap. And that's a part which is going to be a tricky part because a lot of poor fundamental companies, poor quality companies, poor balance sheet companies, poor governance companies, stock price went up 10 times. So do I see bottom there in near terms? May not be. I think there is a good pain is still left from 800th company to 5,000 company. So three buckets, top 100, 100 to 800, and 800 and beyond. The third part is where you need to be a little bit careful. And that, please remember, that's 4,000 companies. So, 70% of market is basically there where at times you get stuck.
So Rajesh, finally, that brings us to the question that everyone has on their mind. If people have some cash to deploy right now, because obviously you're getting better levels, better valuations, where to look? Should they go back to the erstwhile leaders? And we've had that, these flashes in this past week. One day was very good for defense stocks. One day it was some of the industrials that look good. Or should they, look at, safer areas like, say, pharma or banking? Where would you put new money to work?
Where do you think there'll be growth? Because there is no sector which will guarantee the growth. It is a company. So forget the, top-down view. Right now, it is going to be more bottom-up. The top-down has worked beautifully in the last 4 years. But from now on, for next 18 months, focus on the stock specific. Let me give one example. There are broad headlines in newspaper that Indian consumer is under stress because India's largest FMCG company has reported 2% growth. But if you look at the India's largest retail company, is also the consumer company, has reported 40% growth even in third quarter. So consumer is not under stress. You need to be relevant in terms of product. So what I'm trying to say is that, for example, in consumer space, we prefer discretionary. In capital goods, we prefer power capex rather than road capex and railway capex and defense capex. In automobile and auto ancillary, we prefer more auto ancillaries. In pharma, we prefer more CDMO, and so on and so forth. So every segment, you need to further do the micro segmentation and pick your winner, which is a growth, ROCE, and cash flows. These three things are most critical, of course, provided the valuations are reasonable.
Rajesh, have you made any portfolio tweaks in the fall? Maybe you can't talk individual stocks, but some idea in terms of how much has the drawdown been? Have you altered your strategy in any way?
Basically, our strategy is causality. Be quality conscious in what we buy and be agile enough to get out of it. So discipline exit strategy is always our key differentiation, and we keep doing it, whenever we think it requires. So say, for example, capital goods exposure, we have reduced by about, 300 bips, 3-4%, because a lot of stocks have went up through the roof. So good amount of profit booking, we have done. In last 6 months, we moved more into pharma. So pharma is right now almost 9-10% of the portfolio. Specialty chemical, after 4 years, we are liking it again. So from 0%, almost 0%, we are right now about 3.5-4%. Banking and finance, we have increased, a little bit within banking and finance. We like the largest consumer banking finance company. Again, we made it almost like very low. And from that low exposure, we are now back to 3%. So likewise, so every sector, wherever the valuation have already discounting next 3 years earnings, we are basically have reduced, taken profit on the table. And wherever we think from here, we are seeing next 2-3 years going to be very, very solid growth. That's where we are putting money.
Okay. All right, Rajesh, we will leave it on that note. Thanks very much for joining in. Appreciate that perspective today. Well, we do